Hey guys, Shelby Mathis here, and today we're going to go over the top 9 tax deductions for real estate investors. And before we dive into the top 9, I'm going to give you the 10,000 foot view. I wanted to break this in real simple. There's 3 types of income that come from real estate. Generally speaking, you have your rents that come in, so I'm renting it to somebody else. This may be Airbnb-ing. This may be the income from a trade or business, like if you're a flipper or a wholesaler. All these things are a little different, but for our purposes, I'm just going to say real estate investors. You're buying the real estate and you're a landlord and you're renting it out, then that type of income is ordinary income. Your federal tax rate is 0 to 37%, and it's generally considered passive income, right? There's exclusions and ways to get around that, but rents are considered passive income. If you're Airbnb-ing and you're 7 days or less average stay, then you are non-passive. You are now trade or business income, and it becomes very, very different. But for our folks that are out there, and we're just regular old landlord, and by the way, the Airbnb stuff, this stuff's still going to apply. It's just a little bit different, a little bit of a different calculus. But for those of us that are landlords, we're just looking at, number 1, rental income. Number 2, when we dispose of the asset, when we sell the property, we have capital gains. So number 2 is capital gain income. We hold it over a year, we sell it, then our tax rate is 0 to 20%. If you throw in there the net investment income tax, it could be 23.8, right? But it's a lot less than 37%, right? 0 to 37% for the ordinary rate. And then we have capital gains where it's 0 to 20% if it's long-term. And then the third category, I know some of you guys are scratching your head going, there is no third category. Yeah, you have recapture. And recapture is when you take depreciation and you sell and you have a recapture event, then you're paying at your ordinary rate, but it is capped at 25%. So that's actually a big one. It's capped at 25%. A lot of people just say recapture is 25%, and they're missing the planning opportunity. If we can create losses from other activities, we could actually get that recapture down to 0, depending on what your other income is, and it gives us a planning opportunity. Now, 2 and 3 there, that's what a 1031 exchange, therefore I'll just ruin it for you guys right out the gate. We can avoid that entirely. We could spread it out with an installment sale. There's lots of things we could do to spread out, like the capital gains, recapture, you got to pay no matter what on the year that you sell. But there's things that we can do with each type of income. Now, what I'm going to be focusing today on is deductions against that number 1 type of income, the rental income that's coming in. And there's 2 big categories of deductions. This is going to trip you out. Some of you guys, it's going to break your brain. You ready? There are 2 types, cash and non-cash. I want you to start thinking in terms of, did I have to pay that out of my pocket, or do I get the deduction just because I own the real estate? And I'll go over the top 9 tax deductions now with that as our lens. And so I'm just going to put up here a big old here. I'm just going to put cash. Hopefully you'll always be able to see that. And I'm just going to go through one at a time each type of deduction and why it's important, how it's used, and the manner in which we see it used. So number 1 is repairs. I need to keep something in good operating condition. I need to fix things, like I got holes in the walls, I need to fix those stuff. I get to write that off as a deduction, dollar for dollar, against my cash that's coming in for my rental income. So if I have rental income, I get to offset it with my repairs. And the easiest way to think of this is individuals earn money, then we pay tax, and then we get to spend what's left over. So like when you go to your job, your job, and you get paid, they don't even give you the dollar. They take your withholding and employment taxes out of it, so they'll give you 60 cents, right? That's not the case in rental. You get the full dollar, and then you're going to lower the amount of that dollar that's taxable by spending it. So businesses earned income, then they spend it, and then they're taxed on what's left. So if we spend money on repairs, it just means we're going to pay a lot less tax at the end of the day. We're going to have a lot less income that's taxable. But repairs, there's a huge difference between a repair versus an improvement. So a lot of you guys get a property and then you remodel it. The vast majority of that remodel is increasing the value, it's bettering the property, and it is not a repair. It's actually considered an improvement, And improvements, you don't get to write off as a cash deduction. You're going to add it to the depreciable basis, and you're going to write it off as a non-cash deduction under depreciation, which we'll get to a little later. It doesn't mean you're not going to get to write it off. In fact, you may get to write the whole thing off in the year that you did the improvement. There's ways to do that, but it's no longer a repair. Now, there is a safe harbor for repairs. Hey, if I fix stuff, like I have my roof. If I replace the roof, I'm going to end up adding that to the value of the property, and I'm going to depreciate that new roof over 27.5 years. I'm going to write off the old roof, whatever I hadn't deducted immediately because I took it out of service, and I'm going to take a big old deduction in that year. But I can't just write it off as a repair. Some of you guys think, oh, I'm just going to call it a repair. It doesn't work that way. Now, if I have a hole in the roof and I fix it for less than $2,500, repair. I get to write it off. I did not increase the value of the property. I fixed a defect in one of the assets. That's it. If I better the property, increase its value, then chances are it's going to be an improvement unless I can keep it underneath that $2,500 as the safe harbor. Now, that safe harbor doubles to $5,000 if you're keeping financials for any other reason than taxes. This sounds weird, but if you have a loan and you're having to do loan reporting, there's a good chance that your repair, your safe harbor, is probably $5,000 per repair. We like that, right? So that gives us a bigger deduction. So we want to watch our repairs. We don't want to just willy-nilly classify them all as improvements, because a lot of accountants will do that. You want to be able to say, hey, this is what this was for. I fixed this issue. Like, hey, I have a whole bunch of air conditioners. One was busted and I fixed it. Okay, I'm going to call that a repair. I'm not going to call it a betterment, right? And if it's under $2,500, they can't contest it, the IRS. But I got to make sure my accountant's on board and making sure that they're writing that off and not saying, oh, these are all just improvements to the property. No, we don't want that. We want to make sure that we're doing this right. Number 2, I'm just going to call it professional fees. And I'm going to give you a bunch. Your accounting, your legal, but more importantly, your insurance. More importantly, if you have to evict somebody and you had to pay for lawyers, if you get sued, anything that you're paying to a third party as professional fees in mitigating your risk, insurance goes into that category, lawyers go into that category, your accountants could go into that category. We want to make sure that we are writing them off. It came out of my pocket. I want a deduction for it. I want to write it off against my income, and that's what we're going to do. Number 3, property taxes. Unlike if you're an individual where you have a state and local assault limitation, state and local tax limitation, we don't have that when we're an investor. We get to write that off, period, even if it creates a loss. So we want to write off our property taxes. I wish I had a nickel for every time somebody forgot to put their property taxes on there. For whatever reason, people forget that they have property taxes when they're a landlord. We have to pay them. Sometimes it's coming out of the mortgage. We just don't think about it. We get a deduction for that. Make sure that you are looking for your property taxes and that you are writing it off. Number 4, wages, IC, contractor costs, and management. So I want my management fees. I want anything that I'm paying to a third party, I want to make sure that I'm deducting. So if I am paying, if I have an employee that's the handyman or the handy girl that's running around my apartment complex, if I'm paying contractors to do work on things, I want to make sure that I'm paying for them. And then my management cost, even though I may not actually issue a check to the management company, right? They may be collecting my rent and netting it out and forwarding me what's left after they do the repairs and after they pay themselves. I may just be getting the net. I still need to capture that on my profit and loss, and I want to make sure that I'm capturing that as a deduction. Now, a good accountant's going to know how to read those statements, and they're just going to go straight to it, and they're going to be like, aha. But you got to make sure that you're doing it. Like, you got to look at your return and say, these are the things that I want to see on there at a minimum. Number 5. Mortgage interest. All right, now I'm going to break some of your brains. Sorry. that mortgage interest could be against your primary residence. A lot of you guys, your accountants are saying, oh, you can't write it off unless it's for the, the acquisition of your property or the improvement of your personal residence, and you have a HELOC against your house. You access that HELOC and you buy a rental property. That interest is deductible. That mortgage interest on any investment property is deductible. There is no limit on it. There is no, hey, it's up to $750,000 or hey, it's up to $1 million if you bought it before this period. None of that nonsense applies to the landlord, right? You guys get to write that off, period, even if it came from something else. So let's say that I used a credit card and I bought a property with a credit card. And you're like, well, it's not a mortgage. It's not mortgage interest. It's interest, it's investment, and it's on my investment property. I am writing that sucker off, period. Those are your cash. This came out of my pocket. These are things that I actually had to have paid with cash this year to deduct. The rest of them, There's 4 non-cash, and I'm just going to write non-cash down here so that you see it. And I'm just going to go 6. And this is our big one, depreciation. And here's how it works. I buy a property. There's the land on which it's sitting. I can't depreciate that because it doesn't lose its value. There's the box on that land. The IRS says that has a useful life. The useful life for residential property is 27.5 years. Technically, you're supposed to break your property into its 5-year property, its 7-year property, its 15-year property, and its 27.5 when it's residential. If it's commercial, it's 39 years. But I have a useful life for the box that is built on that property. You might have multiple boxes. You may have improvements. Say I put a parking lot in. That is 15-year property. That is not 39-year property. A lot of folks immediately, their accountants just start writing things off over the longest period of time. No, you get a deduction based on the useful life of an asset. So if an asset has I paid $100,000 for it, even if I finance the entire amount, and it has a 5-year useful life, then I'm writing off $20,000, $20,000, $20,000, $20,000, $20,000. Why on earth would I write that off instead over 27.5 years where I'm getting $3,000 a year over this period of time or whatever it is? Right? I am really messing myself up if I do that. And as a landlord, you have it in, like you're supposed to write these things off over their actual useful life. The IRS will allow you to use something called an impermissible method and just write off the house over 27.5 years. And if you don't believe that's what they state, go look at Form 3115 when you change to the right treatment. So when I get a rental property and I walk into it and I look around, I see things in their useful life to me, right? Hey, there's window coverings, 5 year. Hey, there's carpeting, there's 5 years. Removable flooring, 5 years. I go in the backyard, there's a deck. Hey, that's 15 years. I see an appliance over there, that's 5 years. I see the electrical that is attached to that appliance, that's 5 years now. How about if it's the dishwasher and I have plumbing? Okay, that's 5 year now. It's not 27.5 years. I go in the backyard and I see all this new landscaping and a new fence, and that's 15 years. I see a new driveway, 15 years. I see a walkway, 15-year property. I see new trees, 15 years. I get to write those off much faster. It's up to me and my accountant to figure it out. It's called a cost seg if you want to get these broken down into their right components, but it allows you to write off about 1/3 of a house, the improvement value, in as short a year as 1 year. It's called cost segregation with bonus depreciation, but it doesn't come out of my pocket. I could have financed the entire purchase of that property, and the tenants can be literally paying enough money so that realistically nothing is coming out of my pocket on that property. It's going up in value. I have a little bit at the end of the year, but it's buying that property for me, and I don't have to pay any tax because I'm using the depreciation to make the income that I draw off of that property and bring it down to 0 or a negative amount, and then I use it for other things. It's the old adage in accounting is if you're paying taxes, it's because you don't own enough real estate. And this is why, because depreciation is the secret sauce there. Number 2 on that, and number 7 total, non-cash, is our capital gain exclusions. And you're used to this as an individual, right? We have what's called our 121 exclusion. If I buy a house and I live in it 2 of the last 5 years before when I sell it, I can avoid tax on capital gain. If I'm single, it's $250,000. If I am married, it's $500,000. So we're used to those types of exclusions. There's a exclusion called a 1031 exchange. Technically, it's a deferral, but if you just wait, if you just keep your real estate and then die eventually, it steps up. It excludes the capital gain and the recapture. Remember, we had 3 types of income: rental income, capital gain, and recapture. Well, it covers those last 2. Here, I'll see if I can put the right fingers up. Right, it covers the depreciation, recapture, and the capital gains. I can defer it indefinitely and avoid it completely. All I have to do is die with that property, and I never pay tax. Now, unlike the exclusion for your home, which is under Section 121, I can use it every 2 years, and I'm capped at $500,000 if I'm married. There is no cap for a 1031 exchange, and I can do it over and over again multiple times per year. It's per property, and I could do this, and I can use this for tens of millions, if not hundreds of millions of dollars of property if I want to. So I have a much more powerful capital gain exclusion. And then again, it doesn't cost me anything out of my pocket. Like, I'll have to get the qualified intermediary. There might be an expense for actually handling the transaction. But for, like, I could exclude millions of dollars of gain without incurring actual expense. I can literally just go out and find additional properties, buy them. I could do no money down. I could do partial money down. There's so many things that we could do, right? But there's a non-cash tax strategy, huge deduction, right? Again, keeps you from paying any tax on these things. Technically, it's a deferral, but I look at it as in my tax toolbox as a major component. Number 8, and this is for if you are somebody who is making positive income on your real estate and you want to offset it by buying more properties and create losses. Then there's something called active participation, and there's real estate professional. Active participation and real estate professional status, what it does, it allows us to take losses from our properties that are passive and use those passive losses and treat them as non-passive and use them against things like our wages or other income. So let's just say that I'm making $300,000 a year. And I'm like, gosh, I'm getting kicked in the teeth for taxes. And I go and I talk to my accountant, and he says, hey, there's ways to, hey, you and your spouse are going to qualify as real estate professional, and we could unlock some of these losses that you're incurring, paper losses because of your depreciation that you're incurring. Plus, you've grown your portfolio so much, but we've avoided all of our tax. But we have all these losses. How do we unlock some of these losses that we're creating every year? Well, we could fall into one of these 2 categories. We could be a real estate professional, which I'm not going to get into those specifics, but what it does is it allows you to treat your real estate passive losses as ordinary loss, ordinary non-passive loss. You could use it against your W-2 income. You could use it against your other types of income and actually get yourself into a great situation. Active, you have a limit of $25,000 a year, but there's an adjusted gross income limitation between $100,000 and $150,000. You start to phase out. So if you make over $150,000 a year of adjusted gross income, this is after your adjustments, then you would lose the ability to do the active, but it's $25,000 limit. If you're a real estate pro, there is no limit. You can do that. And then the last category, number 9, home office. In the home office, you should absolutely take a deduction for the use of a space in your home that you're using for your real estate. So if you have an area that's like a room that's your office for your real estate activities, then we want to make sure that you are taking at a minimum the home office deduction or administrative office in the home. And what I'd prefer to see you do is create an accountable plan by using a management company or what would be called a family office, management company, whatever you want to call it. It's a corporation. It needs to be an S or a C Corp or an LLC, taxed as an S or a C Corp. And what it enables us to do is write off a lot more for our house because you are using the home, including your utilities, your property taxes, everything. You get to take a portion of it and reimburse yourself tax-free. Not even reported on your taxes, but you get a huge deduction. At a minimum, you're going to take that home office. If you don't have a management company in place, we're still going to write it off. There's a bunch of reasons we do it, but not just the least of which is you get a nice, you might get a small deduction if you're taking the home office, but anytime you leave that house on business, it becomes a deductible mile, and we can start writing those things off too. So then typically when you commute, you don't get to write it off. If I drive to work, can't write it off. But if I drive between offices, I can. And especially if you're in real estate, that can add up, especially if you have multiple properties that you're driving between. Now, anytime you're leaving your house and you go between any of these things, you're going to be writing off that mile. So that you have your cash and your non-cash. Now, because you listened to the end, I'm going to say this. Please like and subscribe, and I'm going to give you a bonus. Here's the bonus. Now, I told you that you could be paying ICs and wages. What I didn't say is that you can pay your kids. If they're under 18, you don't have to do withholding. You don't have to do employment taxes. You can pay your kids, and if it's below the standard deduction, which is over $14,000 a year, they don't even have to report you. They don't have to file a tax return. It's literally taking money from your taxable world and paying them non-taxable world. And you're saying, well, why would I pay my kids? Well, then you buy their clothes with it, pay for their schooling with it, whatever expenses you're incurring with your kids. They have to do something for your rental activity. But if you're a landlord, get your kids. If they're under 18, teach them how to run a broom, or teach them how to do Facebook, teach them how to do your social media, teach them, put their images on your stuff, make them part of your business, so that you can pay them, because you could pay them tax-free dollars and reduce your taxable income. That's a huge one. And we see it up over and over again. If they're over 18, you could still do it, but now they're probably paying some employment taxes, which isn't devastating. You could be having Social Security, but they'd still have a 0% tax bracket for federal taxes if they are below that $14,000 mark. So if you're paying your kids $500 a month to do something, as long as you document it, you could be tax-free money. It could be up to $1,000 a month. It could be more than $1,000 a month. You could be paying them whatever and still deducting it off of yours and moving it into their tax bracket. And yes, you could do that with other relatives, as long as they're doing something for your business. That's why when you start incorporating this idea of a family office or a management company, it starts opening these things up, because you could say, hey, they're sitting on the board, they're doing these activities, they're learning how to operate my real estate, and I could pay them to do it, just like if I could pay any third party, I could pay my kids, but their tax bracket is much, much lower. So that's a little freebie, a little softball to you guys who have kids that are under 18. If you're not doing it, you should, because it's tax-free money, because otherwise that money would have been taxed at your highest level, up to 37 cents on the dollar plus state. Some of you guys are at 50% plus. Get it to your kids at zero. Saves you $1 for every $2 you pay them. It's crazy, right? It's like being subsidized. We'd all love that. Hey, if you like this type of content, please like and subscribe and share it with anybody who you believe would benefit from this information. Thanks, guys.